Hi, everybody. Ed Yardeni here. Sorry I had to reschedule. We had that 11 a.m. schedule for Monday today. And one of our settings, Zoom wasn't happy with, so they played a Halloween trick on us and didn't allow us to move forward. But here we are. We rescheduled it. It's 2 p.m. on October 31st on Halloween. And we've already had the Halloween trick. Now let's see if we can get a treat. Still the autumn weather here. It's been actually a beautiful autumn. Again, I hope it's nice where you folks are. I had to close the window here by my office because when we have autumn leaves, we have autumn gardeners with their blowers, so it makes a lot of noise. So I have that closed, but I'll open it up again once we're done with our session here. This weekend I was in Orlando. I left on Saturday and came back on Sunday. I presented in Orlando at the Omni there. The Money Show had a big conference, so I was one of the speakers. And I'm glad to be back on the road again. I look forward to seeing most of you as I travel more. But it's nice to visit with accounts personally. It's also nice to be able to ask the locals how things are going in the economy. So I did ask my two Uber drivers down in Orlando how things were going, and it turns out they've got a housing boom, they've got a road building boom, they've got a lot of New Yorkers coming down there to live, and so there's the town, the city is doing extraordinarily well. I took JetBlue out of Kennedy and landed in Orlando's JetBlue terminal, the airport there. And it was a brand new one. They had a few kind of kiosks open and all that, but a lot of coming soon for different restaurants and stores. But it's absolutely huge. It's very, very impressive. It's not as swanky as the new LaGuardia Airport, but I'm not a big fan of the new LaGuardia Airport. It's kind of a big maze where you have to go up and down until you finally get to your gate. You can have a very long walk. It wasn't a short walk in the JetBlue terminal in Orlando, but at least it was a straight path and there wasn't going up and down to different levels. But what really impressed me was the size of the thing. And then I just happened to notice, corner of my eye, there's a sign there that said that basically said that some of the money that poured into building that terminal came from the bipartisan Infrastructure Act of last year. I mean, clearly this thing had started before then, but I guess they figured out how to tap into some of that money. But I keep that in mind when you think about my rolling recession idea, the idea that the economy is going to have a growth recession. It's not going to go into a hard landing. It's going to go into a soft landing. But keep in mind that there are towns like Orlando, Austin, Texas, plenty of others where because of migration, you're seeing a tremendous demand for housing, for infrastructure, and so forth, which I think are important offsets to weakness that we're seeing in other parts of the economy. By the way, the drivers also told me that they were just going back and forth between Disney and the airports and other locations. So they've never seen the park more crowded. But they also said that a lot of kids were there with Halloween costumes. So I guess that probably brought in more people. But again, back to the airport, I was just amazed at the size of the video board that shows arrivals and departures. Is like, I mean, Manchester, England. There's a direct flight from Orlando to Manchester, England. So, you know, it's quite impressive. Let's talk about a few things here. Let me go to the charts because I want to discuss more about this rolling recession idea and what the Fed is likely to do with all that. This is a big week again with the Fed. Stock market did pretty well when there was a blackout period for Fed officials. Wouldn't it be nice if we just kind of had a gag order and they couldn't talk at all other than maybe Powell once in a while having a press conference to tell us the bottom line of their discussions. But they'll be back here pretty shortly. On Wednesday, we'll have Powell's press conference. And then I think they have to wait a day. And then the following day, it'll be undoubtedly a deluge of Fed officials talking. I think Powell's going to have to concede that if, in fact, they do 75 basis points on Wednesday, which I think they will, then they're certainly getting closer to restrictive. You might remember that Powell kind of freaked the markets out back in September in his press conference where he said we're at the lower end of the range of restrictive. Well, another 75 basis points is certainly more restrictive. And then we'll see what the hint is about the December increase. I think most of us were expecting 75 basis points. Maybe they'll tone it down to 50 basis points. Last we heard from Jim Bullard, who has a pretty good track record of anticipating where his colleagues are going to go. He said 75, 75, and then pause. And so I think the market is starting to get excited about a pause. I was asked the question by one of our accounts, is pause good enough for the stock market? Don't you really need to see interest rates come down for the stock market to go up? Good question. I think the answer is not necessarily. I think that to the extent that the market believes that getting to 4.5% to 5% on the Fed funds rate is restrictive enough, especially when you factor in what I've been factoring in, which is that the effective Fed funds rate is higher when you look at the fact that we've got quantitative tightening going on, when you look at the fact that this tight monetary policy has led to a much higher dollar. I think just those two alone are equivalent to at least 100 basis points. So from an effective standpoint, tell me what the Fed funds rate is. I'll add 100 basis points and tell you that's how restrictive things are. But it's only been since March that they've really gone full bore here in raising interest rates, and it takes a while. It doesn't take long in the mortgage market. We're seeing the mortgage applications are dropping like a rock, and same thing for housing starts. But I think we're starting to see it in the auto loan market. There's a lot of pent-up demand, but the loan market is tightened up quite a bit. I think we're seeing some recessionary forces in the retailers. The retailers ordered a lot got stuck in the West Coast ports, couldn't get through, then finally made it through. And now they're getting all these goods that there isn't much demand for, so they have to discount them, which is good on the inflation front, but it's sort of a recessionary development. And then, as I said before, people bought a lot of TVs and personal computers during the pandemic, during the lockdowns, and now those industries are paying the price for that in weaker PC sales, TV sales, and that's having some impact on semiconductors. But keep in mind, semiconductors are just about everything these days. And so I think the sell-off is actually a buying opportunity on a long-term basis. What's going well right now, as I mentioned, is we're seeing before, we've got a transition or a pivoting going between demand for consumer goods to services. Real incomes aren't growing all that fast, but as we know, there's excess savings that was piled up during the pandemic. And that doesn't really, I think it's about $1 trillion. It doesn't mean that consumers have to actually dip into that $1 trillion. They might view that as kind of getting ahead of where they want it to be on savings. And what they're doing is they're reducing their savings rate. So whatever income they have, they're spending more of it by saving less of it. And they're saving less of it because they've already got a pile of saving that they accumulated during the pandemic. And so I think that is bolstering their spending, and particularly on services. I'll be covering this tomorrow morning or this afternoon if you get the advanced copy. And you'll see a really kind of interesting chart of real GDP goods consumption versus services consumption. And goods peaked about a year ago, and it's kind of been flat to down. Services just made a new high in the third quarter. So all this talk about the pivot from goods to services, you can definitely see it in the real GDP accounts. Let's have a look at a few things here. First, with regards to the market, I think there's two scenarios that I have assigned subjective probabilities to. 60% is a soft landing, call it rolling recession, call it a growth recession, call it a mid-cycle slowdown. All those terms kind of reflect what I think we're going through now. Some sectors are already in a recession, others are still doing pretty well. And as long as it rolls like that, we may not have very much growth, but we at the same time don't have a hard landing recession kind of scenario. Stock market, I think, made a bottom, or is in the process of making a bottom if it retests it. Kind of leave myself a little door ajar, exit door ajar, but I think 366 was an important level. I know we got down below that level, but I point out that we seem to be more or less consolidating at that kind of level, at least on the downside here. And then on Friday, we went above the 50-day moving average. We're still below the 200-day. Back here, remember, we got to the 200-day moving average on August 16th. And then within a week or two, Powell started talking much more hawkish, much more Volcker 2.0. And now, by the way, I think we're sort of segueing to Volcker 1.5, something a little bit less destructive to the stock market and the economy than Volcker 2.0. And that means 2 rate hikes and a pause. And if the pause will turn out to be bullish, if in fact it turns out to be a more permanent pause because inflation continues to moderate. So 60% is that soft landing, 40% is the hard landing. And in a hard landing scenario, of course, that would be, the bear market wouldn't be over. We'd still have more downside in revenues. We'd still have more downside for the profit margins. So earnings have more downside, whereas in the soft landing, earnings would kind of go sideways for a while. And we'll look at PEs in a second, but so I'm inclined to think that we may very well retest the 43.05 high that we made back here before the end of the year. Basically on a Santa Claus rally combined with how bullish midterm elections turn out to be, no matter who winds up winning, red or blue. But if we do get, in fact, get a red wave, I think that would be even more bullish for the market than your typical just midterm election. So this is just another look at the same thing. Let's move on. Let's look at the forward PE. So the forward PE, as you can see, dropped down to 15.1. We've been thinking that 15 would sort of be the level that would hold. I think here we got to about 15.6. That was back at the 3,666 level bottom, and that was on June 16th. Then we got up to something like 18 on the rally through August 16th. And now we're back since then to a low on October 12th of 15.1. And now we saw on Friday that this thing moved up to 16.6. I think this is going to hold in line with this kind of soft landing scenario I have for the economy and its implications for the Fed and inflation. How about earnings? So that's the forward PE. If the forward PE kind of holds its own, what are earnings going to do? And the answer is, in a soft landing scenario, they go sideways. We've had, for example, remember 2014, 15, 16, that was a mid-cycle slowdown. That was a soft landing for sure. And you can see that earnings there for a while just kind of went sideways before they resumed their climb. So that's what I'm kind of assuming. And that means that, yeah, we can have 2022 earnings continue to decline. Same for 2023. These are analyst consensus expectations in 2024. But 2024, they're talking about $258 a share. And I think that could come down and still kind of leave us with a time-weighted average or the forward earnings number going flat for a while until maybe the middle of next year. These things can last for a while until the middle of next year. And that might continue to give us a range-bound market, which means it's great for stock pickers, not so good for momentum players. And I think this is very much of a stock pickers market. As we saw recently, I mean, who would have thought, we'll see how the Dow finishes up today, But if the Dow just by chance happens to be flat today, then the Dow would be up just for this month alone, 14.4%, which is the biggest increase in the Dow since for the month, for any month, since the 1920s, so since the beginning of the data, actually. Well, I'm not sure about that. It's since the beginning of the 1920s, let's put it that way. So clearly there's been some shifting around from the mega cap 8, from the S&P 500 to the Dow Jones kind of stocks. The Dow Jones only has one mega cap 8, and that's Microsoft. So, you know, the Dow Jones Industrial Average seems to be exactly the kind of portfolio that makes sense in this kind of soft landing environment. So I view that as a confirmation of sort of the way I'm looking at the world. But there's always confirmation bias, so I'm biased, obviously. Now, I can't really explain away the leading indicators. They're bearish. They're telling us that a recession is still ahead of us. They are down about 2.6% since February through September. And they have a very good track record, an excellent track record of predicting recession. So according to the leading economic indicators, which peaked in February, the next recession is going to occur sometime around May or April of next year. My problem with that is housing's already in recession. Autos are kind of in a recession. Retailers are cleaning out inventories. There's a lot of things going on now that are sort of recessionary. So undoubtedly, there'll be some things that could take us down, but how much down can we go when some things have already kind of cleared out? Again, I've just described this as the most widely anticipated recession of all times. And that kind of reduces the likelihood that's going to happen because everybody's going to prepare for it by being careful. I mean, Jamie Dimon, I presume, is being careful with his lending standards, and borrowers are starting to realize that they've got to be more cautious about how much they take out and what they borrow for. Meanwhile, the coincident indicators, all-time record high, but again, that doesn't mean anything. More important is leading economic indicators. Well, it does kind of mean something because we know that one of the coincident indicators that's been remarkably strong has been the labor market. And if there's several factors working there, particularly labor shortages that are going to keep that labor market strong, that's a consideration. By the way, the S&P 500 is a component of the leading economic indicators. They've got 10 components. The S&P 500 is one of them. And according to this leading indicator, and we're in this chart, we're going back to 1945, the S&P 500 anticipates recessions with a 5-month lead time. So it peaked in January. So by May, we should have been in a recession already. And again, I'm going to have my my bias here and confirmation bias and tell you, well, that kind of confirms that we're in a recession. It's just kind of a growth recession. But again, the S&P 500 is has that kind of short-term range of calling recessions. And so far, we're certainly not seeing the kind of recession that will cause us to put in these blue shades showing the recessions. Have a look at the chart on your own when you have time. Meanwhile, in terms of earnings expectations, the analysts, this is the third quarter estimates. You can see that the results are coming in a little bit better than they thought. This is through the October 20th week. Let's see what the next one shows, because that'll have included some of these good and bad results from the mega cap 8 and from the cats of the world that surprised to the upside. McDonald's surprised to the upside. So let's see how that plays out. There usually is an upside hook, as there was here. Let's see what kind of upside hook we get this time around. Fourth quarter, they're still lowering their estimates, as you can see. And then we've got all 4 quarters of next year. And they're still cutting numbers through the week of October 20th. This is analyst consensus expectations for each quarter. They're starting to stabilize a little bit here, a little bit there. So we'll be watching that for you. But again, their earnings estimates can come down, and yet forward earnings don't have to take a dive. They can go sideways because forward earnings are a time-weighted average of this year and next year. Well, guess what? Next year is getting closer and closer. So we're going to see that at the beginning of this year, the forward earnings is going to equal the analyst consensus expectations for next year. And that, I guess, could be somewhere around here where we'll be flat. And then we start to give more weight to 2024. So the 2024 and 2023 estimates could come down, but as we give more weight to 2024, that could also keep forward earnings moving sideways. So that's my scenario for what forward earnings does in a soft landing scenario. Combine that with the PE having hit a bottom and maybe being able to give you some fluctuations, which creates a trading range. It kind of gives you a sideways moving market for a while with plenty of opportunities to be a stock picker. I was asked, well, what has the market fully discounted a hard landing? And the answer is no. We have a hard landing. Earnings have a lot lower to go, and there's certainly potential for much more downside in the forward PE. This is a chart showing you the trailing PE and the forward earnings PE, so kind of a hybrid of the two. And you can look at that on your own. It's really hard to come up with a hard conclusion about what happens to PEs in recessions, because they haven't always gone kind of straight up and then straight down. Look, when they went straight down, even back here, you kind of hit a bottom at around 15. That's kind of the average. And here, if you look at forward earnings on a weekly basis, we're down to 15, 15.1, as I said before. Let's move on. Another positive factor for those of you who are looking for a bottom or think we bottomed, agree with me, is sentiment just been so horribly bearish, just as bearish as it was during the great financial crisis. And I don't think things are as bad as they were back then. We discussed last week how if you look at central banks' balance sheets, the Fed's balance sheet, and know that QT2 is going to reduce that balance sheet pretty dramatically, we know that that can have some correlation with the S&P 500. But then I showed that the forward PE may already have discounted that. So it's not as though the market hasn't kind of discounted that the Fed is no longer going to be the kind of friend we had during the period between the great financial crisis and the great virus crisis, where they kept interest rates near zero and had quantitative easing. But again, sentiment is extremely bearish. This just shows you the bull-bear ratio of 1 or less and what the stock market does afterwards. And during corrections, it's a great corrections indicator, because during corrections, with the benefit of hindsight, it gives you a great buying opportunity. And right away, there's no waiting. There's no need to be patient. In bear markets, you got to be patient. They can kind of stay at this kind of one level or less for quite some time. Here we've been at this one or less level for a while, and have yet to definitively bottom, though I think in my mind there's an argument to be made that we have seen the bottom. There's a discussion at the Mega Cap 8 that you can look at on your own. At this point, I think, well, we did kind of an interesting chart here of the Mega Cap 8's market capitalizations. You might be interested in that. That's a new chart. But let me stop the sharing and let me answer some of your questions. Again, I appreciate that many of you came back to our rescheduled meeting. Others, I hope will look at the replay that we have on the website. But let's go. I've got 3 questions so far. If anybody else wants to throw some in, that would be great. Sheldon, how can the equity market go up in the face of QT? While hard to quantify, QT certainly creates a higher cost of capital. I mean, that's a very good question. And as I said, I showed last week a chart showing QT, the projection of what the Fed's balance sheet is going to do versus the S&P 500. And I think you're right to say, I think in effect you're saying it's a stretch to imagine that the stock market could go up. I think it could go sideways for a while and create buying opportunities along the way. I think energy still makes sense to me. Financials make sense to me in a kind of a soft landing scenario. And I think even technology, semiconductors have gotten awfully cheap here, discounting a real calamity. So I think there's there's opportunities here. It doesn't mean that the whole market has to go up in that scenario. It could go sideways with opportunities. Again, I think we're more likely to see sideways through the middle of next year, range bound kind of market. And then we should be able to start moving to higher ground in the second half of next year. I don't know if we'll see 4,800 again next year, but I think we could be moving in that direction by the second half of next year. There is I think it's tendency to make this all about the Fed. I know that we all know that certainly with the benefit of hindsight, that once again, you don't want to fight the Fed. What's different this time is you don't want to fight the Fed when the Fed is fighting inflation. Before, the bears were fighting the Fed from basically 2009 until January of this year. But the bears kept saying that, if it wasn't for all the QE and zero interest rates, we wouldn't be in a bull market. And I kept saying, so what's your point? The fact is we did have zero interest rates and we did have QE, and that was providing a lift for the stock market. But so was the economy, so were earnings. I mean, it's not like it was all a rig and all kind of fantasy land. And I think, I just keep pointing out that look how well the U.S. economy is doing despite Washington, despite the Treasury, despite the Fed, despite Congress, despite the president. A lot of people work hard for a living, trying to make things better for themselves, for their families, for their communities, for the country. And there's a lot more of us doing good every day than their policymakers kind of screwing up every day. At least, well, that's just a bit of an editorial. So the only other thing I can say is I tend to be an optimist, so maybe that's reflected in this spin. Bing, would you agree that the S&P 500 has discounted negative earnings growth on a year-over-year basis? Negative earnings? No, I don't know. No, I mean, if we actually start to see that earnings are taking a dive, I mean, earnings would take a dive in a hard landing scenario. I mean, it's really kind of that simple. And I think, the leading indicators are telling us that that's still a valid kind of scenario up ahead here. Stock market just kind of maybe got ahead of it. But I'd say that if this is a hard landing ahead of us, and we see that in forward earnings taking a dive, forward earnings never lead recessions. Analysts don't see recessions coming. They just, when it happens, when we all know about it, that's when they're scrambling to cut their numbers. Take a look at that chart that I showed you on forward earnings for during the great financial crisis and during the great virus crisis. But again, I look at the analogy as more mid-cycle slowdowns, and I showed you 2014, 15, 16. I think the market's discounted a soft landing is what I think. Okay, I think this is Gus. Ed, would you have a large cap bias with continued inflation? It's a great question. I mean, mid caps are so cheap. They're amazingly cheap. And I think maybe with the benefit of hindsight, they were early on warning us about a recession because the mid caps don't do well in a recessionary environment relative to large caps. And the stocks definitely underperform, and they've been underperforming since the beginning of last year. So they've been kind of risk off for a long time here, and in many ways have sort of been good leading indicators of where the rest of the market has been going. I wouldn't necessarily conclude that large caps are the winners here if inflation persists. If inflation persists, it's I think pretty clear that, let's say we have 2 rate increases by the Fed, 75, 75, or 50, whatever it is, and then they pause early next year. If inflation doesn't come down, that pause isn't going to last for very long. They're going to be raising interest rates some more, and that's when the hard landing scenario becomes more plausible. And I might very well conclude that, hey, forget about 60-40, it's 40-60, 40 for the soft landing and 60 for the hard landing. So I think inflation always has been the issue, the number one issue here. And if you're telling me that if you're asking me what is the outlook if inflation stays persistent, then the most we're going to get is maybe 1 or 2 meeting of a pause early next year, and then they'll be back in the tightening mode and maybe even more aggressive because they'll be frustrated that what they've done up to now hasn't been sufficient to bring inflation down. So I think they will have themselves concluded that the only way to bring inflation down is with a hard landing. And I think the market will figure that out. And so it could be a pretty miserable spring. Let's say that we get our Santa Claus rally, we get our midterm elections rally. I mean, the midterm election rally should carry us for an entire 12 months and be bullish, but not if the Fed pauses and then resumes tightening and makes it clear that they've concluded they've got to really whack this economy down, put it into recession. Then earnings would take a dive, and then valuation multiples will take a dive. So, hey, look, this is always an interesting business, right? It's never a dull moment, and maybe we can enjoy the rest of the year and early next year, kind of like my soft landing scenario, and then we'll have to reassess things along the way there. Okay, Bill, are you expecting huge capital flight from Brazil if Lulu really is the winner? I'm no expert on Brazil. Looks like Lulu is the winner from what I gather, as the way the vote count has come in. Yeah, I think capital has been flying towards the United States from all over the world. So I don't know the extent to which you'd see a real pickup in money coming out of Brazil. Also, from what I understand, Lulu tends to be on the left side of things, but the vote was pretty much 50-50. So hopefully he gets the message that half the country wants something more conservative than the kind of policies he brings to the table. But I guess you could have said the same thing with Biden. Biden kind of won with the 50-50 majority, and he went totally left. So if Lulu goes totally left, the answer is pretty obvious that money will pour out of Brazil. Well, with that, let me thank you all for tuning in. I think we had a little Halloween trick here with Zoom. Hopefully we've got that fixed for next time, and we'll see you next time. Have a great week.